You are listening to Keystone's Stock Talk Podcast, episode 111. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, we start by talking the M&A activity or lack thereof over the past 6 months of the year and what this could mean for the balance of 2020 and into 2021. In our Your Stock, Our Take segment, we look at an interesting renewable energy finance company. The company Royalties Ltd, symbol RE on the TSX Venture, which acquires revenue-based royalties from renewable energy generation facilities by providing a non-dilutive financing solution to renewable energy generation and development companies. Our star of the week is Westport Fuel Systems Inc, symbol WPRT on the TSX, a transportation technology company which engages in the engineering, manufacturing, and supply of alternative fuel systems and components. The stock was hit hard by the COVID-19 pandemic earlier this year, but is up over 37% in the past 5 trading days. We let you know what is driving the rebound. So let's get into the show, guys. Welcoming my co-hosts, Brennan and Aaron. How are you guys doing?
I'm doing well. How are you, Ryan?
Good. Doing very well. It's getting hot around here, which is nice to see. Enjoying some of the weather. But definitely Aaron, he's not leaving his house. He's been hard at work putting together his live dividend growth stock focused webinar. That is tomorrow. Aaron, are you excited?
Yeah, I'm always excited about doing these seminars. It's a great opportunity to. You
sound thrilled.
I'm extremely thrilled. Obviously, head down into the content and making sure that it's as value added as possible for people. But this is particularly exciting because, of course, it is focused just on dividend growth stock investing, which is my area of focus for the most part. And what we're going to do is we're going to do something a little bit different compared to what we've done in past seminars. What I'm going to do is I'm going to break down the different sectors on the Canadian market, look at what types of dividends each sector is providing, what kind of opportunities there are on a sector basis, and just discussing what areas, like what industries work well for the dividend model and which ones don't. So I think that drilling down into it like that is going to be helpful for people. It's going to give people an idea of how we approach doing our research and finding good opportunities. And then, of course, at the end, we have 3 current recommendations that we're going to provide to the listeners. So this is going to help people get people started building their own dividend growth stock portfolio. And these are companies from each of our 3 risk categories: conservative, moderate, and aggressive. So it gives you a good range of different types of companies that you can look at.
Yeah, and I think you breaking down into what sectors are most suited to pay dividends and grow them over time and which you should avoid is very valuable, because I think a lot of people look at a dividend and they see that, has almost like an interest rate payment going forward. You're guaranteed that going forward. In some businesses, none of them you can look at it as a guarantee, but in some businesses that are far more, they lend themselves better to a model of dividends and dividend growth over time, where there are other industries which do not lend themselves well to this, and yet we see dividends being paid in those segments time and time again. And what crushes returns over time is companies cutting their dividends or removing their dividends. So if you can avoid the segments which have historically had poor records at sustaining or growing their dividends, and in fact have cut or completely gotten rid of their dividends over time, it's going to serve your portfolio well over the long term. And that's one of the things we're going to talk about, and Aaron will break that down for you. So I encourage anybody who wants to look at the markets better that way and learn a little bit about where you should be investing and where you should avoid, take in that seminar. It's tomorrow, 7 o'clock Pacific. Now let's get into. We talking about some merger M&A activity in 2020. It shouldn't be much of a surprise to anybody who's listening out there that M&A activity has been significantly down for the first half of this year. We've seen a shutdown globally, so it's difficult to get out there and visit locations. There was a time where it was difficult to secure financings. Some of that is breaking up now, but there is a significant drop in M&A activity. It was coming out to a decent start to the year, but the year was still down, even ahead of the COVID-19 crisis to start the year. So, there could be a number of factors at play there. One thing, in my opinion, is just the companies that you're looking to acquire have been more expensive. At the start of the year, markets were at all-time highs in some segments. So while that is good for the companies who might be issuing shares to fund acquisitions, those same companies looking to acquire are being asked to pay high premiums in some cases. So there's a bit of a trade-off there. Now the question becomes, in the second half of the year, or even if we look a little bit further out into 2021, is there going to be some pent-up demand? We've seen some companies raising capital as of late. Even our coverage universe, Sangoma and Zillogist, to name two, just in the past week, raising 70 million and 40 million, adding to their cash balances in those cases, having powder dry there to make the acquisitions. Potentially they have acquisitions coming in the near future, or just adding to it. If there is uncertainty, when you've seen prices come up, it may be a good time to shore up your balance sheet and make some opportune purchases if there is another leg down or something like that in the market. Any thoughts, you guys, on the... of course, why the lack of M&A has occurred, but could we see some increased M&A activity as we further see the world open up again?
Well, certainly, I think that
certainly from the lows we will.
Is a major issue. So if we alleviate some of the uncertainty, then I would expect activity to pick up. I think also for some companies, raising capital could be an issue, although valuations, as you said, are not low. So, certainly companies should be able to raise at a decent valuation, or some of the higher quality companies anyways. But essentially what we have is a situation where valuations are high, but uncertainty is also high. And I think that there are, I know of companies in our Dividend research and also our U.S. growth stock research as well that are sitting there. They have the cash. Typically they make acquisitions. They haven't really been active over the last quarter, but I'm sure they're just waiting for the right time.
Yeah, if you look at a serial acquirer like the Boyd Group, for example, they raised some cash, but they're just sitting on it right now. And, we expect... it's been difficult to get out there and view. You got to view that auto body shop. You got to talk to the person, shake the hand. These are how their acquisitions were done in the past. So all of that has come on pause. You got a management team in Canada, part of their management teams in the US. You can't really cross borders, so it's hard to sign those deals. There's likely some talking going on, and there's likely some opportunities as, in some of the segments. In auto body repair, for example, you've seen volumes down significantly. At one point, they were cut by more than 50%. As you see that, there's probably some opportunities. Some of those companies, the smaller mom and pop businesses, can be cash strapped, but it's hard to complete those acquisitions. So there's some areas where there's going to be pent up demand. Enghouse is another serial acquirer, all out of cash flow. Had their biggest year in terms of acquisitions last year, really made some prescient acquisitions in two of the segments, telemedicine and video conferencing, essentially in the healthcare segment, that have really, I doubt they predicted this scenario. I know they didn't, but it's really served them well this year. But again, this year, they made an acquisition to start the year, but then completely silent from then on. You just can't get out there and do the due diligence necessary to make a full acquisition. So we'd expect at some point there is going to be some pent-up demand and some acquisitions that could be made. And many of these companies are generating cash, not employing when they would. So there's going to be that pent-up demand. Perhaps, some of them see prices that will be too high near term, and then maybe it goes into 2021. If there is a downturn, they take advantage then. But we'd certainly rather be on the side of companies with a lot of cash in the bank and available to make those acquisitions, or just hoard it until the prices came to the range that they believe would be accretive over the long term. So certainly continuing on that theme of looking at cash producing businesses, but companies that have great balance sheets as well, I think, and that's going to serve you well in any M&A type environment, really. One thing that we haven't seen this year is we typically, because we own what we'd say are fairly solid businesses, we haven't seen an acquisition from a company in our coverage this year, which is quite frankly very rare. Typically, when you're holding cash-rich businesses that generate cash flow, that trade at relatively reasonable valuations, something gets bought, like private equity buys out something. So perhaps in the second half of the year we see that, or into 2021. But it's something to look to when we start to see some acquisitions out there and that opens up. So if we could go to our Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We got a question here on RE Royalties from Naveed via YouTube. He said, I would love your take on RE Royalties. Love the business model, and they have some good royalty streams already set up. They have a good balance sheet and lots of tailwinds. So RE Royalties, symbol RE on the TSX Venture, currently trades at $1, about a $32 million market cap. It's paid a dividend in about a cent per quarter, roughly yielding 4% in that range. What does the company do? RE acquires revenue-based royalties from renewable energy generation facilities by providing non-dilutive financing solutions to renewable energy generation and development companies. They currently own 86 royalties on solar, wind, and hydro projects in Canada, Europe, and the United States. Now, management believes they have identified an underserviced segment of the renewable energy capitals market that lies between traditional debt and equity financing. For many small and medium-sized renewable energy companies, a royalty or revenue-based royalty financing has many advantages with respect to flexibility, cost, and contractual terms. Now, we've seen traditional royalty-based financing being used extensively in North America in the resource sector, consumer service, industrial manufacturing, healthcare, music, food sectors, all of those segments. So this is a little bit of a departure from that, but with the long life of the assets, it does make somewhat sense. Now let's look at the Q1 financials of this company. We saw total revenues. Now it's a small base of revenues here, but it went up about 57%, up to $442,000. The company has recorded net income in 2 of the last 5 fiscal quarters. There is significant seasonal variance or variation in its royalty projects, likely because in renewable generation, for example, in wind, you might have a windy season that produces more power, and other seasons where it's less windy, so you have less power production. So let's look at the valuations. There is good growth in this business, but if we look at EV to EBITDA, it's over 250 times right now. Their EBITDA just over the last, on an adjusted basis over the last 12 months is just in the range of 125,000, so low. Their total revenues for 2019 were roughly 1.4 million. Again, so this is a small business, but we have seen a couple, as a cautionary note, we have seen a couple of royalty businesses essentially blow up in the past. They were lending to businesses that did not hold longer life assets or utility type assets. So from that perspective, the type of assets that RE holds may lend themselves to this model more. However, they do see higher quality assets being able to raise capital we do see higher quality assets in this segment being able to raise capital at decent rates in the alternative power and green power market. So the question for me would be whether RE is choosing from a pool of lower quality assets. I guess it could be argued that they are partnering with just smaller assets, and the potential could be smaller and higher quality. So, there's that argument too. To grow, these type of businesses typically have to issue shares. We have already seen RE double its share count over the past year. This is something we would monitor. It can be a tightrope that is difficult to walk. The practice of issuing shares and being able to generate significant enough return on the capital raised to create incremental cash flow per share. This is what ultimately will drive the share price. Again, over the last year, we said revenue is $1.4 million. The company, if they're going to pay that 1 cent in dividend each quarter, it will pay out over $1.25 million in dividends in 2020. Revenue will have to keep that upward trajectory that we saw in Q1 for that to be possible. The business is certainly interesting, and in a segment of the market we see and like long-term and see good potential in, but we are monitoring it now, and we will be looking at it in our upcoming Canadian Alternative Energy and Green Energy Special Report. At present, for us, it would just be a monitor.
Yeah, certainly. And I like the idea of, just from a very general perspective, the idea of investing in renewable energy projects and getting a royalty. One of the concerns that I would have on a company like this is, you mentioned 86 different royalties, and they're only generating about 1.4 million in revenue. I don't know if all of those, if some of those royalties are newer, so that they could be generating additional revenue going forward. But I mean, that's a very small amount of revenue per royalty. And one of the challenges with some of these royalty streamers is that you need to know the businesses that they're invested in, the assets that they're invested in. And when you're so spread out amongst almost 100 different investments, it's extremely difficult for an analyst to really dig deep into each one of those individual royalty streams and determine how quality they are. Because you really need to know that. You need to know who the partner is, how old the assets are they contracted, where are they located geographically, and what is the political risk. So that would be a concern. It would make it difficult to analyze the company. But I mean, even before that, as you mentioned, Ryan, they are over distributing right now. So I've noticed that about a 4% yield on the stock. I think you said dividend payments of 1.25 million per year, yet they're only generating EBITDA of less than 200,000. So it's that would be another issue from a perspective of a dividend analyst. We always tell people, don't chase the yield, don't invest in companies that are over distributing. A lot of companies like to start off with the big yield with the intention that they can one day grow into it. But we think that's putting the horse, or the carriage before the horse. We really think that you need to start off with a prudent strategy. Don't distribute more capital than you're taking in. You should actually be distributing less, and then just allow your dividend to grow over time as your cash flow grows. So not something that we would be advising people to invest in right now.
I think Ryan brought up a pretty good point too, just saying how green energy valuations are pretty high. So, right now, what green energy company will really want to, go with a royalty when they can possibly issue more shares and get a, just a better way of financing their company? Would you guys not agree with that, or is that not what you were kind of touching on?
Yeah, I mean, and that's the question I kind of posed. It does seem like they're going in a size of the market where many of these companies aren't public that they're doing the royalties to, and they were probably too small to be public at present, or have a smaller range of projects. So they're finding a sweet spot where they can where a royalty becomes more attractive for these companies. Hopefully what we're looking at is high quality assets that are just too small to essentially be in a public or vended into a public asset at this point. So, if they can find that sweet spot in there and grow that over time, it can make sense. When we've seen royalty or streaming or royalty type companies, blow up in the past, they're not investing in long life type assets or utility type assets. If that's indeed the case here, this type of model potentially makes more sense with these type of longer life assets. So we will, it is interesting. There is cash flow coming in. It is volatile, and I do believe, like, out of the 86 assets that they quoted, it is only a small portion of those that have come online and are actually producing cash flow right now. So as the new assets come online, like you see with a mining streaming company or royalty company, they may have, options on 80 properties or something like that, and only 5 of them are actually producing right now. So in this case, we would hope for REs over time, more of those assets would come online and start producing cash flow for the business as they are brought into production. So if we see that, it may be a company that we continue to look at going forward. We'll certainly be doing a little more due diligence on the business over the next 6 to 12 months. So now let's move on to our star of the week. From our Stars and Dogs segment, it's time for this week's Star. And that is on Westport Fuel Systems Inc., symbol WPRT on the TSX. Brennan, that's yours.
Thank you. So yes, another green energy company here. It's currently trading at a price of $2.44 and has a market cap of $278 million. Now, what does the company do? Westport Fuel Systems Inc. is a transportation technology company which engages in the engineering, manufacturing, and supply of alternative fuel systems and components. Its fuel systems and components are for clean, low-carbon fuels such as natural gas, renewable natural gas, propane, and hydrogen, and they're providing these to the global automotive industry. Now, the star performance, the stock was hit hard by the COVID-19 pandemic earlier this year, but is up over 37% in the past 5 trading days. The COVID-19 pandemic has impacted Westport Fuel Systems quite drastically, and this is just due to both the disruption of production and end customer demand. Its 3 primary production facilities in northern Italy were shut down from March through May, and the company does expect weaker customer demand for the remainder of 2020. But in recent news, the stock is being driven by a few news releases where on July 24th, the company announced that they secured a 15 million euro credit facility to improve its liquidity during the COVID-19 pandemic for working capital, payroll, and potential investments. And also the prior day, on July 23rd, the company announced that they had received a US $10 million credit facility from Export Development Canada to additionally help with their liquidity needs. So, looking at the company's financial results, this is for Q1 2020, and this is all in US dollars. Revenue decreased 8% to $67.2 million compared to the same quarter last year, caused by negative impacts of COVID-19 on commercial activity, particularly in Europe, management said. Adjusted EBITDA decreased to negative $3.6 million from a gain of $7.3 million for the same quarter last year. And this change was primarily due to a large warranty charge. Basic earnings per share was a loss of 11 cents compared to a loss of 2 cents for Q1 2019. And just looking at some 12 trailing month figures here, 12 trailing month revenue was $299.3 million, up a little bit compared to $279.9 million for the same 4 quarters last year, and 12 trailing month adjusted EBITDA was $17.5 million. And just a note here, the company will be releasing its second quarter results on Thursday, August 6th, which we will certainly be digging into for further analysis. Looking at the company's balance sheet, they have a net debt position of $46.4 million and a net debt to EBITDA multiple of 2.65 times, which is relatively attractive. However, if the company does use its most recent credit facilities to their full potential, this multiple will increase to over 4.2 times, which could be a cause for concern. We will certainly have to monitor the company's debt going forward to see if it increases drastically. Now, looking at the company's relative valuation, based on Westport's 12 trailing month adjusted EBITDA of $17.5 million, the company has an enterprise value to adjusted EBITDA multiple of approximately 17.5 times, which, considering headwinds in the commercial sector, along with its need for additional credit facilities, I would say this multiple places the company trading at approximately fair value. Now, Westport Fuel is an innovative company that is providing cleaner carbon fuels, which we certainly see a demand for in the future. And the industry definitely has some excitement around it right now. But seeing as the company expects further headwinds throughout 2020 and has been increasing its debt to deal with liquidity needs, we will continue to monitor the stock at this time. We are actually coming out with a comprehensive report on, like Ryan said, alternative energy and green energy stocks listed in Canada. So keep your eye for the release of this report, which will likely include an update and further dive into Westport. Now, with this being said, we will continue to monitor the stock, and its recent share price performance has made it our star of the week.
Yeah, I mean, Westport's an interesting company, history dating back over 20 years in the public markets. It's had various times where in bubble scenarios, like in the tech bubble, it ran up to as high as $67 or $70 in that range, $69. It trades around $240 now. In 2012, it was up to $40. It's come back down, but this company has just historically not been able to put out anything close to consistent profitability. It can bounce all around, but there's no consistent growth path. In fact, if you look back over the last 20 years, it's done not much but lose shareholder money over that period. So it may be, it's got tailwinds at its back right now in terms of being in the alternative energy, cleaner energy market, which may be a good thing over the long term. We've seen that happen 2 or 3 times over the past 20 years. Near term, there was some excitement. It ended badly for shareholders over the long term. We'll monitor Westport this time to see if it's different.
And of course, debt, significant amount of debt, lack of profitability, lack of consistency, that is far more important to us to consider at Keystone than whether or not it falls into an exciting space right now. So
yeah, and Brennan said they just secured a loan to address, liquidity issues, right, and to improve liquidity. And yet the share price is up 20% as I see today. So there is some activity on the market right now that leaves us shaking our head, and not saying that that's completely with Westport. There's some companies out there that have zero revenue that have had significant increases as of late that really are on speculation rather than the fundamentals. In the end, they will come back to their fundamental valuations. We've seen that in many other hot sectors in the past. We can go on and on about the cannabis sector, about how we saw sky high prices in some, and now in many of those names, you see them down 70-80% because they never should have been there. So trying to invest in hot trends over the long term is just going to get you with lower amount of capital to deploy in the future to buy some good businesses. It's just not a way to invest over the long term and create wealth. So I'd like to finally, again, we'll close off the show today, but remind everybody to get their tickets to that focused webinar on dividend growth stock investing on July 28th. Aaron's going to talk about, this environment. You've got bonds, GIC, savings accounts paying far less than 0.5% in many cases. High quality dividend stocks paying 3 to 7%, just your best option for the long term. Why dividend stocks in Canada, dividend growers have outperformed all other forms of all other stocks over the past 33 years. And Aaron's just going to look at the dividend sectors in Canada and the US and where you should be employing your capital and which areas that do not suggest a dividend model should be used over the long term. So hopefully you can attend that. I encourage you, keep your questions coming into our Your Stock, Our Take segment, our Ask Us Anything segments as well, and we'll endeavor to answer those in a timely manner. As always, stay safe, and I wish you profitable investing. Thank you.
Profitable investing.
Thanks, everyone.